Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most interesting companies on the market, Mastercard.
Oh, it's a giant. Absolutely ubiquitous.
It is everywhere, isn't it?
Mhm.
But here's the thing. We're not just looking at it as, a piece of plastic in your wallet or a way to buy coffee. We're looking at Mastercard as a digital toll booth on the global economy.
That's the perfect analogy. A toll booth that takes a tiny slice of almost everything that moves.
Exactly. And on the surface, it looks like the perfect business. It has this massive, massive moat, incredible margins, and literally everyone uses it. But the real question for us as long-term investors, especially right now in January of 2026, is this. Are there hidden cracks in this fortress that the market is just completely ignoring? Is the era of their incredible pricing power finally peaking in the face of, all these regulatory headwinds and new tech? That is the mission of today's analysis.
That's a huge topic and a really important one. Before we dive deep, though, a quick heads up for the audience.
Right, if you're looking to invest, we use Interactive Brokers. You can use the link in the description, and you'll get a stock bonus when you sign up.
It's absolutely the best way to get a bonus for yourself and support the channel at the same time. We really appreciate it.
And while you're down there, please like, subscribe, and definitely let us know your questions in the comments. We do read them.
Now let's get into it. Pillar number 1. The business model.
Okay, let's unpack this right away,
Okay.
because I think the biggest misconception about Mastercard, and Visa too, for that matter, is that people think they're banks.
All the time.
I was talking to a friend just yesterday who was complaining about, and I quote, Mastercard's interest rates.
Right. And that is the fundamental misunderstanding. It's what separates, the casual observer from someone who really wants to invest in this space. It's
Yeah.
a crucial distinction.
So break it down.
Mastercard is not a lender at all. They do not have a balance sheet that's full of consumer loans. They don't take on any credit risk. They are not the ones chasing you down if you default on your payment.
That's the bank's job.
That is the bank's job. JP Morgan, Citi, Capital One, whoever issued the card. Mastercard is purely, and I mean purely, the infrastructure, the network.
So if they're not the bank and they're not actually lending the money, what exactly is their function in that, say, 2 seconds when I tap my card?
They're the rails. Think of them as the black box that sits right in the middle of the whole transaction.
Okay.
When you tap your card to buy that coffee, a packet of information has to travel from the merchant's terminal through the system to your bank to authorize the funds.
To make sure I actually have the money.
Exactly. And then a message has to come all the way back to the merchant to approve the sale. Mastercard provides the secure, high-speed digital highway for that information to travel. They are the messaging layer, not the money layer.
And like any good highway, there's a toll. But explain how that toll is actually calculated, because it's not just like a flat 50 cents per transaction, right?
No, not at all. And this is really where the business model gets so beautiful from an investment standpoint and, well, maybe a bit frustrating if you're a merchant.
I can imagine.
They charge 2 main types of fees. The first are what we call assessment fees. These are a tiny, tiny percentage of the gross dollar volume, or GDV.
So the total amount of money that's flowing through the system.
Precisely. Every single time money moves across their rails, they take a little basis point cut, a fraction of a percent.
Okay, let's play that out with a real-world example.
Yeah.
If the price of my coffee goes up because of inflation, say, from $5 to $6, does Mastercard's revenue go up automatically from that one transaction?
Yes, instantly. And this is one of the most powerful aspects of the business. It is effectively a royalty on global GDP.
A royalty on global GDP. I like that framing.
If the economy grows, they grow. If inflation rises, they get an automatic raise without doing a single thing.
Because their costs are basically fixed.
Exactly. Their costs are largely fixed in nominal terms, servers, engineers, office space, but their revenue is floating on top of nominal prices. It creates this beautiful widening jaw between revenue and expenses during any inflationary period.
That's incredible. And that's just the assessment fees. What's the other part?
The other part is the switching fees. These are the fixed fees for actually processing the transaction, regardless of its size. So it's a tiny fee every time the switch is flipped.
So they get you on the volume, the total dollars, and they get you on the activity, the number of transactions.
Correct. They catch you coming and going. It's a phenomenal setup.
It really sounds like a dream business. But that brings me to pricing power. Usually in a competitive market, you can't just keep raising your prices year after year.
You'd think so.
Merchants would scream, regulators would get involved. But when I look at the data here, it seems like Mastercard just defies the laws of economic gravity.
They really do. They exhibit what economists would call inelastic demand. And you're right, merchants absolutely hate the fees. We see lawsuits filed every other year.
Sure.
Regulators are scrutinizing these swipe fees constantly. But when you look at the numbers, year after year, the effective fees go up and the volume just keeps growing right alongside them.
Do we have recent data on that?
Yeah, just look at the data for 2024 and 2025. Cross-border volume, which is international spending, a very high-margin business for them, grew about 18%.
18%. For a company this size, that's massive growth.
It's staggering. It shows the secular trend is still very much intact.
Okay, but wait a minute. Let's go back to the merchant. If I'm running a small business, and you, Mastercard, keep raising my fees, my single biggest variable cost after labor, eventually I'm going to revolt. How are they hiding these price hikes? Or are they just blatant about it?
Well, that's the genius of it. They aren't just raising the base toll, the headline rate. They are layering on what they call value-added services, or VAS.
Value-added services. Okay, that sounds like classic corporate speak for more ways to charge me.
It can be, but let's look at what it actually means for, say, the guy running the coffee shop you mentioned.
Okay.
VAS refers to things like advanced cybersecurity, sophisticated fraud detection, data analytics, loyalty program management.
And here's the nuance, right? Technically, these services are optional. A merchant or a bank doesn't have to buy Mastercard's premium fraud protection package.
Yep.
But there's always a but.
But can you really afford not to? In a world where cyber threats are just exploding, where fraudsters are getting more sophisticated every day.
It's a risk you can't take.
Right. If you opt out of the premium security and then you get hit with a massive fraud attack, or your legitimate customer decline rates skyrocket because you aren't using their optimization data, you are out of business. It's an existential threat.
So it's a price hike wrapped in utility. Feels a little bit like a protection racket, doesn't it?
Yeah.
Nice little shop you have here. It'd be a shame if all your customers' cards started getting declined.
That is the cynical view, and it's probably the view of many, many merchants. And there's some truth to it.
What's the charitable view?
The charitable view is that Mastercard is uniquely positioned to see the entire global threat landscape. They process billions of transactions. They can stop fraud better than almost anyone on the planet.
So they're selling a genuine competency.
They're selling that competency, yes. So it effectively becomes mandatory. You pay more, but you get better security and smoother operations. The key point for investors is that it allows Mastercard to increase their revenue capture, their take rate, without officially raising the swipe fee headline rate that politicians and regulators hate to see go up.
That is incredibly clever. It's a shadow price increase. And it also decouples their growth from just pure transaction volume. They can grow by selling more services into their existing network.
That's the strategy. And it's working.
Okay, now let's talk about the unit economics, because this is where the numbers just get staggering. I'm looking at the filings. Operating margins are consistently around 58 to 59%.
Which is almost unheard of for any company, let alone one of this scale. It's just in a different stratosphere.
For context, for our listeners, a typical good physical business, a restaurant, a retailer, might have 10, maybe 15% margins if they're excellent.
Maybe, on a good year.
Apple, which is arguably one of the best hardware businesses in human history, is usually around 30%. Mastercard is nearly double that. How is that even sustainable?
It comes back to the software nature of the business. Think about the physical world. If Ford wants to sell more cars, what do they have to do?
They need more steel, more rubber, more factory floor space, more workers on the line.
Right. Their costs, their variable costs, go up directly with their revenue. Mastercard is completely different. Once the rails are built, once the fiber optic cables are laid and the data centers are up and running, the marginal cost of processing the next transaction is effectively zero.
So whether one person taps their card today or a billion people tap their cards, the incremental cost to Mastercard hardly changes.
It's just a few electrons moving through a server. The cost base is almost entirely fixed, but the revenue scales linearly with economic activity. That is the definition of operating leverage in its purest form.
So every new dollar of revenue almost entirely drops to the bottom line as pure profit.
That's why the margins are so high and why they're so stable.
Okay, so the engine is perfect. It's a cash-generating machine. But a perfect engine usually attracts thieves, or at least competitors. Why hasn't someone else just built a cheaper highway?
And that leads us directly to pillar number 2, The moat,
The fortress.
the fortress. This is the wall that protects those incredible profits.
You've identified two main powers here, two main moats. The first one is network effects. Now, we hear this term thrown around all the time for, social media companies, but how does it apply so powerfully to payments?
It's a very specific and very potent type called a two-sided network effect. The mathematical way to think about it is that the value of the network, which we'll call V, is proportional to the square of the users, or n squared.
Okay, let's break that down into plain English.
Let's think about the classic chicken and egg problem. It's the best way to understand it. Why do merchants, from the biggest retailer to the smallest street vendor, accept Mastercard?
Well, because everyone has a Mastercard in their wallet. If I'm a merchant and I don't accept it, I'm literally turning away customers and losing sales.
Exactly. There are, 3.5 billion Mastercard branded cards in circulation globally. 3.5 billion. If you open a new shop and you put up a sign that says no Mastercard, you're effectively telling half the planet they can't shop with you.
It's business suicide. Now flip it around.
Right. Now flip it. Why do you and I carry a Mastercard?
Because every single shop accepts it.
Hmm.
I know I can walk into a bodega in New York or a cafe in Paris or a market in Tokyo, and it just works. There's no friction.
Exactly. The 100 million plus merchants who accept it compel the 3.5 billion consumers to carry it, and the 3.5 billion consumers compel the merchants to accept it.
It's a self-reinforcing loop.
It is. So now imagine you're a startup. You have this brilliant new payment technology. You start on day one with 0 consumers and 0 merchants. How do you possibly get one side of that network without having the other?
You can't. It's the empty nightclub problem. Nobody goes to the club because it's empty, and it's empty because nobody goes. You can't get it started.
Precisely. Unless you have massive government intervention, which is a risk we will definitely get to later, it is basically an insurmountable barrier to entry. It creates this winner-take-all, or in this specific case, a winner-take-two, since Visa is right there with them, dynamic in the market.
Okay, that is a powerful, powerful moat. Let's talk about the second one, which you've identified as branding. Now, I usually think of branding as, I like Nike because it's cool, or I trust Coca-Cola's taste. But you frame Mastercard's brand differently as trust and risk reduction.
Because in the world of payments, branding isn't about being cool, it's about being sure, it's about certainty.
What do you mean by that?
Imagine you're traveling. You're in a foreign country, you don't speak the language, you're a little disoriented, and you need to pay for a taxi or a meal. You look at the door of the restaurant and you see that little red and yellow interlocking circles logo on the window. What is the immediate emotion you feel?
Relief. Total relief.
Okay.
I know it's going to work. I know I'm not going to get scammed, or at least if I do, I have recourse. I can call my bank and do a chargeback.
That is the moat. The brand is a proxy for reliability and security. It guarantees the transaction will clear instantly and safely. That mind share, that immediate feeling of relief, is what you'd call a cornered resource.
A cornered resource of mindshare.
Yes, it reduces the cognitive load for the consumer. You don't have to download the new local payment app and figure out how it works. You just pull out the card you trust.
That makes total sense. It creates a deep behavioral lock-in. And actually, looking at the outline, you've applied a mental model here that I love. It's called the Lollapalooza effect. This is a classic Charlie Munger concept, right?
It is. It's one of his best.
Explain this for the audience because it's so powerful.
Of course. So Charlie Munger, Buffett's partner, talks about how when you have multiple behavioral biases all pushing in the same direction, their effect isn't just additive, it's multiplicative. They combine and compound to create this massive, overwhelming force, a Lollapalooza. It's like a psychological avalanche that drives a certain behavior.
So what are the specific biases that are converging here to lock us into using Mastercard? What's the avalanche made of?
Oh, I think there are 3 main ones that are incredibly powerful. The first and most basic is social proof.
Everyone else is doing it.
Everyone uses it, so it must be the right thing to do. It's the default behavior of the tribe. You see your parents use it, your friends use it. It's just what people do.
Okay, that's a powerful one on its own. What's the second?
The second is habit, just the sheer physical muscle memory of tap to pay.
You don't even think about it.
You don't think about it at all. It is so frictionless. You reach for your wallet, you pull out the card, you tap. You don't make a conscious decision to use Mastercard over, say, cash or a bank transfer. You just do it. It's an automatic, ingrained behavior.
And the third. This is the killer, I think.
The third, and you're right, this is probably the most powerful, is incentive bias.
Ah, the rewards, the points and the miles.
The points, the miles, the cashback, the travel insurance, the rental car coverage, the entire credit card ecosystem is designed to reward high-spend consumers for staying inside the ecosystem.
This is the critical piece that I think a lot of the crypto enthusiasts and fintech disruptors often miss.
They miss it completely.
Yeah.
If I use a crypto payment rail or a new pay-by-bank app, what do I, the consumer, get? Nothing. Maybe I save the merchant a few percentage points on their fees, but I get zero personal utility from that.
But if you use your Mastercard,
If I use my Mastercard, I get 2% cash back on everything, or I earn points for a flight to Europe. The incentive bias is so strong that it locks the most valuable customers, the high spenders, into the network. It's effectively a kickback scheme that the consumer absolutely loves.
so it's an incredibly hard habit to break because the habit literally pays you to keep it.
Exactly. That is the Lollapalooza. You have society telling you to do it, your own muscle memory telling you to do it, and your wallet telling you to do it.
That is a deadly, deadly combination for any potential competitor. No wonder crypto has struggled so much to break into daily payments.
It's a behavioral wall, not just a technological one.
But every fortress has a potential weakness. We got to do an anti-moat check. Nothing lasts forever. So who is the real threat here? It's not Visa, right? They're in the same boat.
No, Visa is the frenemy. They coexist quite happily in a comfortable duopoly. A price war would hurt them just as much as it would hurt Mastercard. They have no incentive to rock the boat.
So who is the real enemy at the gates?
The real threat is a strategy called counterpositioning. It comes from technologies that bypass the card rails entirely. We're talking about real-time payments, or RTP, and especially the government-backed rails.
Things like FedNow in the US, PIX in Brazil, or UPI in India.
Exactly. These are systems designed to move money directly from one bank account to another instantly without ever touching the Mastercard or Visa toll booth.
And the key is that they do it at a fraction of the cost, or in some cases completely free.
That is the existential threat. However, and this is important, Mastercard is not just sitting there waiting to be disrupted. They've executed a classic and very smart strategic hedge.
You're talking about their acquisition of Vocalink.
I am. I recall that acquisition. It was a big deal at the time. Vocalink is the core infrastructure behind most of the real-time payments in the UK, right?
Yes, BACS and faster payments. But let's dive into why that acquisition was so strategically brilliant. The UK was one of the first major economies to really push non-card real-time payments. By acquiring Vocalink, Mastercard effectively bought the disruption. They bought their own competitor.
They bought their own potential replacement. They now own the infrastructure for real-time payments in the UK, and more importantly, they are now exporting that technology and expertise to the Nordics, to the US, to help build out RTP to parts of Asia.
So their long-term strategy is, if the volume of payments inevitably shifts from the old card rails to these new bank-to-bank rails, Mastercard still wants to be the one operating the switch and taking a fee.
They are hedging their bets. They're trying to own the toll booth on the new highway, too. It's a tacit admission that the card rail might not be the only game in town forever, but the need for a secure, reliable switch in the middle is eternal.
That's incredibly smart. If you can't beat them, buy them.
It's the only move they could make.
Okay, that's a perfect transition. Let's move to Section 3, financial resilience. We've established the business is great, the moat is wide, but we need to talk about the quality of the money they're making. Because you can have a great story, but if the numbers don't work, it's not real investment.
And the numbers here absolutely work. They sing. And the best way to prove it, the ultimate measure of a compounder, is to look at the spread between ROIC and WACC.
Okay, let's just quickly unpack those acronyms for everyone. ROIC is return on invested capital. Basically, how good is the company at investing its own money to generate profits?
Correct. And WACC is the weighted average cost of capital, how much it costs them on average to get that money in the first place, either from debt or from equity investors.
So the difference between the two, the spread, is the value they create. It's the pure economic profit.
That's the magic number. And for Mastercard, that number is almost unbelievable. Their ROIC is consistently hovering between, say, 56 and 59%.
59% return on capital. And what's their cost of capital? Their WACC.
It's around 8.7%.
So the spread is nearly 48%. I mean, that's astronomical.
It is staggering. I can't emphasize this enough. To put it in perspective for you, a good company, a company you'd be happy to own, might have a spread of 10%. A company with a spread of 2% is barely treading water. Mastercard is nearly 50%.
What's that mean in practical terms?
It means for every single dollar that they retain and reinvest back into the business, they are creating about $6.50 of market value over time. It is an absolute wealth-generating machine.
And why is that ROIC so incredibly high? Is it just because of the high margins we talked about?
It's the margins combined with the extremely low capital intensity of the business. They don't need to build billion-dollar factories or maintain a huge inventory.
Their biggest asset is intangible.
Exactly. Their biggest asset, that brand trust we talked about, the network itself, doesn't even sit on the balance sheet as a line item you have to maintain with capital expenditure. So the denominator in that equation, the invested capital, is artificially low, while the numerator, the return, is incredibly high.
That is a recipe for compounding. Okay, so that brings us to how they spend all that cash they generate. You've labeled their capital allocation strategy as the Cannibal. That sounds aggressive.
In the investment world, a cannibal is a term of endearment. It's a high compliment.
Right.
It refers to a company that aggressively, relentlessly eats its own shares through buybacks. Mastercard has a massive ongoing share repurchase program. We're talking in the range of $11 to $12 billion a year allocated to buybacks.
So they are constantly reducing the number of slices in the pizza, which makes each remaining slice bigger and more valuable for the shareholders who stick around.
That's the perfect analogy. And what this does is it allows them to grow their earnings per share, their EPS, faster than their actual net income is growing. It's financial engineering in the best possible way.
It also puts a sort of floor under the stock price, doesn't it?
It does. It acts as an automatic stabilizer. If the stock price drops for some reason, their buyback program becomes more effective because they can retire more shares for the same amount of money. Management loves seeing the stock dip.
What about dividends? Do they pay out much cash to shareholders?
They do pay one, but it's very modest. The yield is only around 0.6%, and that's by design.
Why?
Because they know, and we as investors should know, that a dollar is worth far more being compounded inside this incredible business at a 56% ROIC, or used to buy back shares, than it is being paid out to us as cash where we just have to pay taxes on it.
Reinvestment is the priority.
It has to be.
Now, I have to ask about something that can be a red flag in many tech and finance companies. Stock-based compensation, or SBC.
A very important check to make.
I see so many cloud companies, for example, that claim to be profitable, but then you look closer, and they're paying their engineers millions and millions in stock, massively diluting the shareholders. Is Mastercard guilty of this?
We checked this thoroughly because it's a critical point. The trailing 12-month SBC is about $1.45 billion.
Okay, that sounds like a lot of money in absolute terms.
It is a large number. But context is everything. Their operating cash flow is around $15 billion, so the SBC is less than 10% of their cash flow.
And how does that compare to peers?
It's very reasonable. You compare that to many of these high-flying SaaS or software as a service, companies where SBC can be 20, 30, sometimes even more than 40% of their revenue, let alone their cash flow.
So they aren't just funding the business by diluting shareholders to keep the lights on.
Not at all. The cash engine is real and overwhelming. They are funding their operations from their massive profits, not from printing new shares. And crucially, the buybacks far, far outweigh the dilution from SBC. The net share count is going down every year, not up.
That's a huge green flag. Okay, so the financial engine is pristine. But what about the future? That brings us to Section 4. Growth and valuation.
The billion-dollar question.
It's January 2026. The stock is trading at roughly $527. Is there any growth left in this story? Or has this giant tree already grown to the sky?
The growth engines are definitely shifting and maturing, but they are far from dead. The first and maybe most surprising engine is still just basic cash-to-card conversion.
Really? I feel like I haven't touched a physical cash bill in a year.
I know, it feels that way, but you live in a bubble. We all do in major financial centers. But globally, personal consumption expenditure is still only about 50% digital.
Half of it is still cash.
Roughly half of it is still cash and check. Go to large parts of Southeast Asia, go to Latin America, go to rural parts of Europe, or even the US. Cash is still king in many, many places.
And what about B2B?
That's the other huge runway. Business-to-business payments are still shockingly analog. So many companies are still mailing physical checks to each other. There's a huge runway left just in digitizing what is currently paper.
Okay, so that's one engine. And the second,
The second and the faster growing one is value-added services, which we touched on earlier.
the data and security stuff.
Exactly. This segment is growing faster than the core transaction layer. They are selling sophisticated data analytics, loyalty program management, and even consulting services to banks, merchants, and governments. This diversifies their revenue quality in a really important way.
So they aren't just dependent on you buying things anymore.
They're dependent on the entire financial ecosystem needing their data and intelligence to run more efficiently and safely.
And consensus estimates seem to back this story up. I'm seeing the market is expecting about 16% revenue growth in 2025, and then slowing a bit to 12% in 2026. Those are still very solid numbers for a mega cap company.
They are. And what that implies is that the market believes this secular shift to digital payments is going to continue even with all the recession fears that might be looming on the horizon.
Okay, but here's where it gets tricky for me. The valuation. At $527 a share, the price-to-earnings ratio is around 34 times earnings. That is not cheap. For a company in the financial sector, that is a nosebleed multiple.
It is not cheap. You're absolutely right. It is priced as a safe compounder. It's a sleep-well-at-night stock, and you pay a premium for that.
What does a multiple like that imply?
When you pay 33 times earnings for a stock, you are effectively making two statements. First, I believe this company will grow significantly for a very long time. And second, I believe the risk of this company failing or being disrupted is near zero. The price reflects that certainty.
You ran a reverse DCF, a discounted cash flow analysis, to see what growth rate is baked into the price. What did you find?
To justify the current price of $5.27, Mastercard needs to grow its free cash flow at roughly 12 to 14% annually for the next decade.
12 to 14%. And can they do that? Is that realistic?
Well, their historic 3-year compound annual growth rate, the CAGR, is about 14%. So the market is essentially pricing them to continue doing exactly what they have been doing recently.
So it's priced for perfection, or at the very least, priced for continuation of their excellent track record.
That's the perfect way to put it. This means if they stumble, if growth unexpectedly drops to, say, 8% for a couple years, the stock gets crushed. There is no margin of error baked into this price. It is not a bargain.
You also triangulated the intrinsic value using a few different methods to get a range.
Yes, just to get a fuller picture. If we use a simple historical mean reversion, taking their 5-year average PE ratio, which is about 32 times, and applying it to the 2026 consensus earnings estimate, we get a value of around $611.
So that implies some upside.
It does. And Wall Street analysts' consensus targets are generally in that 608 to 660 range. So the professionals think there's still some room to run.
But there's always a but with these models.
But if we use a more conservative owner earnings model, which is more of a Buffett-style approach, where we assume growth decays over time as the company matures, we get a fair value of around $540.
And the stock is trading today at $527.
Exactly. We are right in the zone of fair value. There's no free lunch here. To get a true margin of safety, that classic 20% discount to fair value that Graham and Buffett always talk about, we would need to see the stock drop down into the 430 to 450 range.
So as of today, January 24th, 2026, you're essentially buying a dollar for a dollar, a very, very high-quality dollar, but you are not getting it on sale.
Precisely. You're paying full price for a masterpiece.
Well, that leads us perfectly into the scary part of the conversation, Section 5, the risks. Because if we are paying full price, we need to be absolutely paranoid about what could go wrong.
We have to run a pre-mortem.
Exactly. You have a kill list here. What is the #1 existential threat to this investment case? We touched on it earlier, but we really need to go deep on this.
It's the regulatory kill switch, specifically a piece of legislation in the U.S. called the Credit Card Competition Act, or CCCA.
Right. We've been hearing about this in the news, the swipe fee legislation.
Yeah.
It's been floating around Congress in various forms for a few years now, but it feels like it has more momentum lately.
It does. It has gained a lot of bipartisan momentum, actually. It taps into that Trump-Vance era populism on the right that's skeptical of big corporate tolls, and it fits with the anti-monopoly sentiment on the left. The core idea of the act is to break the payment processing duopoly of Visa and Mastercard.
How would it actually do that mechanically? Because the government can't just wish a new competitor into existence. The network effect is too strong.
They get around that. The legislation focuses on payment routing. Currently, when you use a Mastercard issued by, say, Chase Bank, the transaction must go over Mastercard's rails. The bank and the network are exclusive partners for that card. The CCCA would force the big banks to allow merchants to route that transaction over a different, cheaper network if one is available.
Whoa. Let me make sure I understand this. So I walk into a store, I tap my Chase Mastercard. The merchant's terminal could theoretically say, hey, Mastercard is going to charge me 2.5% for this, but the NYC network or the Star network will only charge me 1%. And the merchant could choose to send my payment over the cheap network instead.
That is exactly what it would do. Or more likely, the mere threat of the merchant doing that would force Mastercard to lower their toll to match the price of the generic competitor.
But hold on, if my payment gets routed over the generic network, does Mastercard still get paid at all?
They might get a tiny fraction or maybe nothing at all, depending on how the final rules are structured. But the main catastrophic damage is to their pricing power. If this act passes, it absolutely crushes their ability to raise fees every year. It turns their monopoly highway into a competitive commodity market where the lowest price always wins.
That is terrifying for this investment case. If they lose that pricing power, that beautiful 58% operating margin collapses.
It is, without a doubt, the single biggest risk to the long-term thesis.
Yeah.
And here's the kicker, the second-order effect. If those interchange fees collapse, the rewards programs collapse too.
Right. My 2% cash back is funded directly by those merchant fees.
Exactly. So if the CCCA passes, the banks have no money to fund the rewards. They'll have to slash the programs. And if the rewards suddenly disappear, does that Lollapalooza effect we talked about earlier suddenly break apart?
It could.
If I'm not getting my points anymore, do I still have the same incentive to use my card? Or do I just switch to a cheaper method like a debit card or a direct bank payment?
That unraveling of the consumer habit could be very swift and very damaging.
It could be. Now, you can be sure the banks and Mastercard are lobbying furiously against this, arguing it will hurt security and consumers will lose their rewards. But the political risk is real, and it is non-zero.
Okay, so that's the domestic threat. And then there's the international version of this. You call it sovereign disintermediation. That sounds like a sci-fi villain's plot.
It's just a fancy way of saying governments building their own roads and making them free.
We mentioned UPI in India and PIX in Brazil. Let's focus on PIX, because it's a great case study.
It is. PIX has completely taken over Brazil in just a few years.
How did it happen?
It's a state-sponsored instant payment system run by the central bank. It's totally free for individuals to use, and it's extremely cheap for merchants. And the adoption has been explosive.
So if you're in Rio, you're using PIX to pay for lunch, not your credit card.
Overwhelmingly. The merchant prefers it because the fees are lower and they get their cash instantly, not in 2 days. And the consumer loves it because it's simple and it's built into every banking app.
The danger for Mastercard is contagion.
That's the word. What if the EU gets serious about creating a unified, state-backed payment system to rival the American duopoly? What if the U.S. FedNow system actually becomes a viable, popular consumer product?
If that model gets exported successfully, Mastercard gets cut out of domestic transaction volumes entirely in those countries.
Correct. They would be relegated to just being a cross-border travel card. Oh, I only use my Mastercard when I fly to London. That would shrink their total addressable market, their TAM, by a massive amount.
Okay, and lastly, you noted a softer, more subtle risk signal, some insider selling.
Yes, looking at the filings from late 2025, we saw some consistent programmatic selling by the CFO and a few other key executives.
Now, to be fair, executives sell stock for all sorts of reasons. They need to buy a house, pay taxes on vested options, diversification, divorce.
All true. You can't read too much into any single sale. But when you see widespread, consistent selling at these valuation levels, it serves as a mild yellow flag for me.
It suggests that the people who know the business best don't think the stock is massively undervalued right now either. They aren't backing up the truck to buy more shares with their own money.
No, they seem content to take some chips off the table. And they know exactly how serious these regulatory winds are blowing.
Okay, let's bring this all together. It's time for the final verdict, the synthesis.
If we were to score this company on quality, it's an A+ elite. There are very few businesses on Earth that have a duopoly with 58% margins and a 56% ROIC. It is a masterpiece of a business model.
But on valuation?
On valuation, it's a C+4. There, maybe a hold. At $527, you are paying for every bit of that quality. It is a compounder at a fair price.
Okay, I want to play red team here for a minute.
Okay.
I'm going to be the skeptic. I'm the guy who thinks this whole thing might be a value trap.
Go for it. Give me the full bear case.
Okay. You're telling me to buy a stock at 33 times earnings. That's an
Yep.
earnings yield of, what, 3%? I can get more than that on a treasury bond with zero risk. But here, I'm looking at what is essentially a legacy toll booth. The U.S. government is actively threatening to regulate their fees into the ground with the CCCA. Emerging markets, which are supposed to be the growth engine, are building their own free highways, like PIX. And a dozen fintech companies are trying to build tech to bypass their rails. It feels to me like Mastercard's pricing power peaked in 2024. Aren't we just waiting for slow, painful capital impairment here? Why on earth would I pay 33 times earnings for a utility that is about to get regulated?
That is the bear case. And it is a very strong one. You've laid it out perfectly. If the CCCA passes in its current form, 33 times earnings is way too high a price. You will lose money.
So convince me I'm wrong.
Okay, let me offer the rebuttal a bull case.
Hit me.
First, inflation. As long as the world has some level of positive inflation, Mastercard's revenue grows. It is the ultimate inflation hedge, and that's incredibly valuable in a portfolio. Second, data. The growth in the VAS, the value-added services, decouples them from being purely dependent on that transaction fee. They are becoming a data company, not just a payments company. They're on their way to becoming the Bloomberg terminal of consumer behavior.
And what's the third point?
The third point is the cannibal factor. Even if top-line growth slows down because of these pressures, the aggressive buybacks put a mathematical floor under the EPS growth. They will engineer growth by shrinking the denominator, even if the numerator slows. They are shrinking the float so fast that your personal share of the pie grows, even if the total pie stays the same size for a year or two.
So it's a bet on management's ability to navigate this transition from a pure payments network to more of a data and services company, all while returning massive capital.
It is. It's a bet that those interlocking circles are too embedded in the global psyche and commercial infrastructure to be easily displaced. It's a bet on that Lollapalooza effect holding firm against the headwinds.
So what does this all mean for the listener who might be thinking about this stock?
I think it means if you already own it, you probably keep holding it. It's a world-class compounding machine, and you don't sell your winners just because they've reached a fair price. If you're looking to start a new position, you might want to be patient. You might want to wait for a dip.
Wait for some bad news to hit the headlines.
Exactly. Wait for some scary headline about the CCCA to scare the market, and then use that fear to buy the dip and get that margin of safety we talked about.
A watch list stock for the patient investor.
Patience is the edge here. You let the quality come to you at a price you like.
Before we sign off, I want to leave our listeners with one final provocative thought to chew on. We've spent this entire hour talking about Mastercard as a payments company. But consider this. In a world where data is the new oil, is Mastercard actually a payments company anymore? Or have they quietly, over the last decade, become the world's most important behavioral data broker?
That is the big, slightly scary thought, isn't it? They know what you buy, where you buy it, when you buy it, and what you buy it with. In aggregate, they know more about the real-time health of the global economy than the Federal Reserve or any government agency.
And if that's true, if they're a data intelligence agency first and a payments company second, is that the real reason governments are suddenly so keen on regulating them? Is this really about a few basis points on swipe fees, or is it about who controls the master ledger of human behavior?
It definitely raises the stakes. It changes the entire narrative from toll booth to panopticon.
Something to mull over. That is all the time we have for this week's deep dive into Mastercard.
Thanks so much for listening.
We'll see you next time on Synaptic Investing. And don't forget to check out that interactive brokers link in the description.